The concentration cascade, how a 20% Mag-7 correction turns into a 40% S&P 500 collapse. There's a mechanical process unfolding in the markets right now that virtually no retail investor understands, but that every institutional investor fears. It's not about valuation divergence or sentiment swings. It's about the collision of three forces: massive portfolio concentration in a small number of mega-cap stocks, predictable pension fund rebalancing policies, and leverage embedded in margin accounts across the financial system. When these three forces intersect during a market decline, they create a cascade of forced selling that transforms a moderate correction into a severe crash. The mathematics are mechanical, the precedent is clear, and the stage is being set for 2026. Understanding this cascade is essential for retirement planning because it operates independently of market sentiment or economic fundamentals. It's a system dynamic, and system dynamics can create shocks that leave unprepared portfolios devastated. Let's start by examining the concentration problem from a different angle than the simple market cap weight approach. The S&P 500 has 500 companies, but the Magnificent 7 represent approximately 35% of the index. This concentration has reached levels that haven't been seen since the 1970s, but here's the critical detail that gets missed. This concentration is not evenly distributed across the investment universe. Approximately 43% of all retirement savings in America flows through index funds and passively managed accounts. That represents roughly $10 to $12 trillion in assets. These passive funds must hold the index in its exact proportions. When the index is 35% concentrated in the Magnificent 7, the passive funds are automatically 35% concentrated. This is mandatory. There's no discretion. A pension fund manager cannot say, "I think the Magnificent 7 are overvalued, so I'll underweight them in my S&P 500 index fund." They must hold them at exactly 35%. Now, imagine what happens when the Magnificent 7 experience a 20% decline. Their market capitalization falls by approximately $1 trillion. They become 31% of the index instead of 35%. For index funds holding these stocks, they're suddenly overweight. They must rebalance to maintain their index weightings. To rebalance, they need to sell the Magnificent 7 to bring them back down to 35% and buy the remaining 493 companies to bring them back up to 65%. But here's where the cascade begins. The index funds are not the only sellers of the Magnificent 7 during this decline. Pension funds, which manage approximately $8 to $10 trillion globally and $4 to $5 trillion in the United States, follow similar rebalancing policies. Most pension funds maintain target allocations, typically 60% equities and 40% fixed income. When stocks decline 20% while bonds remain relatively stable, the pension fund's allocation might drift from 60-40 to 56-44, equities underweight, bonds overweight. To maintain their 60-40 target, pension funds must sell fixed income and buy equities to bring equities back to 60%. But within their equity allocation, they typically hold index funds or index-like portfolios. So the mechanics repeat. They're forced to buy equities broadly, which means buying the non-Magnificent 7 stocks to maintain their index weighting. This sounds logical so far. The problem emerges from the predictability of this process. Academic research from the CFA Institute has documented that pension fund rebalancing is extraordinarily predictable and costly. Major pension funds rebalance on specific schedules: month-end rebalancing, quarter-end rebalancing, and annual rebalancing. Market participants know these schedules. They know that a market decline will trigger forced buying of stocks as pension funds rebalance their equity allocations. Financial institutions have documented that this predictable rebalancing costs pension funds approximately 8 basis points per year in losses to front-runners who see these trades coming and position ahead of them. But the real danger emerges when we consider what happens during a crash scenario where multiple rebalancing triggers occur simultaneously. Imagine a scenario where the Magnificent 7 declined 25% in the span of 2 weeks due to earnings disappointments. Pension funds receive their quarterly rebalancing notices. Index funds recognize they're overweight. Both need to sell fixed income and buy equities, which means buying non-Mag-7 stocks. Simultaneously, margin call dynamics begin to work their destructive power. Here's where the leverage cascade becomes critical. The Federal Reserve reported that margin debt in 2023 was approximately $800 billion. With rising equity prices throughout 2024 and 2025, margin debt has likely risen to $950 billion to $1 trillion. This represents the amount of money borrowed from brokers to buy stocks. When stocks are held as collateral for these loans, a decline in stock prices reduces the equity in these margin accounts. Brokers protecting their loan books enforce maintenance margin requirements. Typically, these require that the equity in a margin account stay above 25 to 30% of the total account value. Let's model this mechanically. An investor borrows $1 million on margin to buy $2 million worth of stocks at the initial 50% margin requirement. If those stocks decline 20%, they're now worth $1.6 million. The equity in the account is $600,000, $1.6 million in securities minus $1 million in borrowed money. That's 37.5% equity. The account is still above most maintenance margin requirements. But if stocks decline another 10%, they're worth $144 million. The equity is now $440,000 or 30.5%. That's right at the maintenance margin threshold for many brokers. One more 5% decline pushes the account below maintenance margin, triggering a margin call. The investor must either deposit additional cash or sell securities. In a declining market with liquidity pressures, most margin investors are forced sellers. They sell whatever they can liquidate quickly. During the Magnificent Seven decline, the most liquid assets are the Magnificent Seven themselves. So margin investors sell them. But here's where it accelerates. As margin investors sell the Magnificent Seven to raise cash, the price declines further. A further 5% decline to $137 million in value triggers more margin calls. More forced selling occurs. The cascade accelerates. Research on margin calls during market declines shows that the effect is multiplicative. For every 1% decline in stock prices due to fundamental factors, margin call forced selling can amplify that decline by an additional 0.5 to 1%. In a 20% Magnificent Seven decline, forced selling from margin calls could add another 10 to 20% to the decline, pushing it to 30 to 40%. But the cascade doesn't stop there. As margin investors are forced to sell and as index fund rebalancing proceeds mechanically, the liquidity and trading volume in the Magnificent Seven stocks increases. Bid-ask spreads widen. The institutions trying to execute these rebalancing trades find that their orders move prices more dramatically than they expected. They're not able to buy and sell in nice round number quantities. They're moving the market with their trades. Meanwhile, hedge funds and other leveraged investors who also held positions in the Magnificent Seven begin experiencing their own margin calls. They're forced to sell across their entire portfolios, not just the Magnificent Seven. They sell quality names to raise cash. They sell small cap stocks. They sell international equities. The forced selling spreads beyond the Magnificent Seven into the broader market. This is the classic definition of a financial contagion. It starts in one area, the Magnificent Seven, and spreads through mechanical processes, margin calls and rebalancing, to the broader system. What began as a 20% decline in the Magnificent Seven has become a 25 to 30% decline in the Magnificent Seven, combined with a 10 to 15% decline in the broader market. Then, a second-order effect begins. As the broader market experiences significant declines, pension funds find their equity allocations have drifted even further below target. The fixed income portion has held up better. Now the equity allocation is only 55% instead of the 60% target. The pension funds have to sell more fixed income to buy equities. But the equities they're buying are in a collapsing market. They're buying into weakness. Additionally, some institutional investors who were holding the Magnificent Seven as quality names they intended to hold long-term suddenly realize the market is treating these stocks as concentrated risk rather than quality assets. They begin to diversify away from them. They sell the Magnificent Seven and buy other sectors, other regions, other asset classes, but there are only so many buyers for all this selling. Bid prices decline, selling accelerates. In the most severe cascade scenarios, what began as a systematic rebalancing process and margin call pressure becomes a panic. Retail investors, watching their portfolios decline 30 to 40%, panic and sell. They call their advisors demanding to sell stocks. The advisors, overwhelmed with calls, begin liquidating positions. The panic feeds on itself. The decline accelerates from 30 to 40% into potential 40 to 50% territory. Historical precedent provides examples of this exact dynamic. In 2008, the decline wasn't purely driven by the fundamental deterioration of mortgage securities. It was amplified by forced selling from margin calls, from pension fund rebalancing, and from institutional deleveraging. The S&P 500 fell 57%. But studies of the 2008 decline suggest that 30 to 35% of that decline came from fundamental factors, credit crisis, financial system stress, while 20 to 25% came from forced selling mechanics and leverage dynamics. The concentration of losses in certain sectors and the speed of the decline suggest that mechanical factors amplified the underlying weakness. In 2000, the concentration in technology stocks reached about 30%. The Nasdaq fell 76% over 30 months. The S&P 500 fell 49%. The difference between the Nasdaq decline and the S&P 500 decline is instructive. The Nasdaq was more concentrated in tech, so it experienced more severe forced selling. The S&P 500 was more diversified, so it declined less, but the Cascade still reached the broader index because of the rebalancing mechanics we've described. Today's scenario is particularly vulnerable to cascade effects because the concentration is even higher than in 2000, 35% versus 30%. The amount of passive capital bound to mechanical rebalancing is vastly larger, 43% of retirement savings versus a much smaller percentage in 2000, and margin debt is near record levels. The stage is set for a cascade of substantial magnitude. For a retiree, the specific vulnerability is in the sequencing and speed of the decline. If the Magnificent Seven decline 25 to 30% over the course of several months, the cascade effects are manageable. Pension funds rebalance gradually. Margin calls are triggered but managed. The broader market declines 10 to 15%, which is recoverable. But if the Magnificent Seven decline 25 to 30% in the span of a few weeks, triggered by an earnings disappointment or a shock to AI spending assumptions, the cascade accelerates. Multiple rebalancing events and margin call forcing functions happen simultaneously. The broader market doesn't decline 10 to 15%, it declines 25 to 35%. A 35% portfolio decline combined with a 4% annual withdrawal creates severe sequence of returns risk. The current market structure makes this cascade more likely than it's been since 2007-2008. The concentration is higher, the passive capital base is larger, the leverage is comparable, the triggers are visible, Q1 2026 earnings season, the SOM rule approaching its trigger, the first signs of margin compression becoming undeniable. When one of those triggers fires, it will cascade through the system. What makes it particularly insidious for retirement planning is that traditional diversification doesn't protect against this cascade. If you own an S&P 500 index fund, you're 35% concentrated in the Magnificent Seven. You're also mechanically forced into the rebalancing trades that amplify the decline. If you own a 60-40 portfolio of stocks and bonds, you're forced into the pension fund rebalancing dynamic that forces buying into a declining market. The mechanical forces don't care about your personal financial circumstances or retirement needs. They execute regardless. The defensive positioning requires moving outside of these mechanical structures. It requires reducing concentration in mega-cap stocks. It requires increasing cash allocation so you don't have to participate in forced selling. It requires understanding that during cascade scenarios, holding 20 to 30% in cash or short-term bonds is not a conservative position. It's a critical survival mechanism. The concentration cascade isn't speculation. It's a mechanical process waiting for its trigger. Pension fund rebalancing happens automatically. Margin calls execute automatically. Index fund rebalancing happens automatically. When these mechanisms all fire during a market decline, they amplify that decline substantially. A 20% correction in the Magnificent Seven doesn't result in a 20% market decline. It results in a 30 to 40% decline through cascade amplification. Understanding this process and positioning defensively now, before the cascade begins, is the difference between a portfolio that survives and one that becomes seriously depleted.